Hi, I'm Matt Cabangon and I'm the president of AAA Equities. And today I'm going to be giving you a quick crash course on how to cut your losses. We'll be covering three different types of cut loss strategies. It's the percentage stop, the chart stop, and finally the trend stop. But before we continue with the hows of cutting your losses, let's talk about why it's so important. I believe that cutting losses is what separates the successful traders in the market from those who eventually get wiped out. I think it's extremely important and should be the foundation of every trader's discipline. I've met hundreds of traders, clients, and brokers who have succeeded in this market with different strategies. Some succeed relying on fundamental analysis, some are fantastic at reading charts, but really all of them share one key strength, in that they are all masters of risk management. And being adept, being a master of cutting your losses is the foundation of a good risk management strategy. And the biggest challenge that clients and traders really have in executing their cut loss plan is their own psychology. We hold on to positions for far too long and end up abandoning our trading plan. Luckily now there are platforms like AAA Equities that allows you to set your cut loss automatically in advance so that we are never put in that tough position of whether or not we should be cutting our losses. And with that, let's jump right into our first trading strategy, the percentage stop. Our first cut loss strategy is the percent stop. It is a very simple but effective way to manage our positions. It involves defining how much capital we are willing to risk for a given trade. I personally like to use a 5% stop for most of my trades. For example, let's say I were to buy JGS at 70 pesos per share. I would cut my losses if the stock goes down by 5%, down to 66.5 pesos per share, no matter what. The pros of this strategy is that I have to really commit to my discipline, and there's really no room for bias whether or not I'll be cutting my losses, since I am defining my capital at risk at 5%. I highly recommend that beginning traders use the percent stop when they're first getting a feel for the market to really build a good discipline for cutting their losses early and effectively. Once you get more familiar with the market and reading charts, we can move to more advanced cut loss strategies, which brings us to our next one, the chart stop. Our second cut loss strategy is the chart stop. And like it says in the name, we refer to the chart to figure out when and where we should be cutting our losses. We use technical analysis to find support levels in the market, and once those levels are breached, we immediately cut our positions. There are many ways to find out what support levels are, but I personally like to use the previous low as a reference for where to find support levels. So if I were to enter a trade and see that it breaches that support level or previous low, then I immediately cut my position. This is a great strategy for traders who want to maintain their cut loss discipline, but also get better at technical analysis. But because finding support levels might be a little tricky for beginner traders, you might be more subject to bias than if you were to use something more defined like the percent stop that we talked about earlier. The final method that we'll be talking about is the trend stop. The trend stop involves following a trend as indicated by an indicator like the simple moving average. If you're the kind of trader who likes to follow very short-term and fast trends, then you can use something like the 20-day moving average as your support level on when to exit a trade. If you're a more long-term kind of trader, something like the 100-day moving average might be more appropriate. Shorter moving averages allow you to get out of trades early, but also puts you at risk of getting whipsawed, since shorter moving averages tend to be quite noisy as signals. Longer moving averages are less noisy, but you end up exiting your position at a worse price than if you were to exit at a shorter moving average. The trend stop's biggest advantage over the percent stop and the chart stop is that it also doubles as a trailing stop, because since you're following a trend, your cut loss point naturally moves higher with your position. So you're only really selling your stocks once the trend is invalidated or turns against your favor. And there we have it. Hopefully I've given you a basic understanding of why it's important to cut your losses and how you can use strategies like the percent stop, chart stop, and trend stop to conquer the market.